Okay, good morning and welcome back everyone to our Friday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. Markets are relatively quiet here this morning, responding a little bit towards the non-farm payroll and employment numbers that came out, but let's go ahead and get started and take a look at where we stand, how the markets have reacted to the election results so far, and what opportunities we see as a result of the current elections outcome. So let's go ahead and get started. But before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell securities. Today what we're going to do is we're going to start off by talking a little bit about the general market update. This is really looking at where the broader indices are currently trading. We'll also look at some specific sectors that were more sensitive to the outcome of the election and seeing how they have responded so far. I do want to take a look at global markets as well, because global markets have largely decoupled a little bit from US equities, as we have stalled a little bit due to the election outcome and the election reactions. So I want to take a look at where we see some opportunities. We've already talked about this earlier this week, as far as emerging markets coming to life here, especially in Asia, where we see some of those opportunities. I want to make sure that you understand them, especially as US equities kind of slows down a bit and loses some relative strength on the global scale. I do want to take a look at fixed income and commodities as well. We've seen some interesting moves from both the fixed income market and the commodities market. We'll take a look at the economics and the current data that we're currently looking at across energy, across employment, and then share with you some of our ideas and try to answer a few questions here at the very end. So a lot to get through, so let's go ahead and get started. But the primary question that I want to help investors navigate here today is really, what can we expect from markets over the next couple of weeks, as what we expect a contested election is likely going to be in place, what we can expect from markets during this time. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you my charts, my research, and my views as far as where we think markets can head over the next few weeks and longer term, maybe over the next couple of months. So when we take a look at the broader market here, when we look at the SPY, we have a very clear established trading range now between 323, if you want to be fairly accurate, and about 352, 353 to the upside. So 353 to the upside was established here in early September. We tested it again here just about a month ago, and now due to the election run-up that we had, which was a result of the fact that the current likely election outcome, which is a Biden victory with a split government, from a market's perspective, is one of the more favorable election outcomes, because you have a president that's potentially less volatile, with a Senate that is, or a Congress that is unlikely to allow him to pass sweeping tax changes that the markets were concerned about. So you have this market rally, or a bit of a knee-jerk reaction to that outcome. So markets have rallied substantially over the past couple of days. If we look at this just from a purely technical perspective, letting go of fundamentals and the election outcome, what we have is just simply a market that's trading near the top of its range, of established trading range, near the resistance level. Short-term indicators are fairly overbought. You have market breadth that's not particularly strong, and all signs point to what looks like more of an established trading range. And so far, that's what we had this morning. Now, earlier to this morning, we were down about 3-4 points here on SPY. It rallied back up. Looks like it's about to open up just about 0.2% below yesterday's close, because of non-farm payrolls, employment numbers coming out a little fairly strong here in about 30 minutes ago. But overall, we are still within this range. When we are in this range, our expectation is that markets will stay within this range. And largely, I think that lines up with the fundamentals of a contested election. Contested elections historically have led to about a 5% decline in the broader markets. So my belief is that it's going to be tough for markets to rally and break out of this range as we continue to have a contested election here. So history lines up with that particular view. If we look at the NASDAQ 100 index, almost the exact same setup here, fairly established trading range between 260 and 295 or so. Near the top of the range, fairly overbought. Momentum is overbought. Market breadth isn't particularly strong, and we're at the top of the range. So just purely from a technical perspective, our expectation is to fade this strength. Now, if we do see a breakout to the upside, there is a fair amount of upside, that potential here, because we have a fairly established range that have been in place for about 2 months now. If we do get a breakout, there is quite a bit of upside, but fundamentally speaking, I think that the likelihood of that is on the lower end. However, when we look at the broader markets, we have seen this slow rotation into value. We've been talking about it for quite some time. We talked about it when IWM broke out above 160, which is a major level it's been trading below for a long time. Managed to break back above it a couple of weeks ago, but failed to hold that level and managed to break back above it again. And IWM significantly stronger than the S&P and the other markets. Looks like it's about to open up higher here today versus SPY and QQQ are both about to open a little lower than yesterday's close. Not only are we seeing the slow rotation into value through IWM, we're also seeing in the equal weight S&P 500 index, which is actually outperforming the market cap S&P 500 index. So the mega cap names are underperforming the smaller cap names. That's why the equal weight index is outperforming the market cap weighted indices. So this is particularly strong long-term for the broader markets. This is a bullish signal for the broader markets. But during the contested election over the next couple of weeks, during the current trading range that we've established, as of right now, we haven't broken out above that range. From my perspective, during a contested election, during a transfer of power, that is unlikely going to happen until you have that transfer of power. And that could be a month, 2 months. At this point, it's really too early to tell as to what this transfer of power is actually going to look like. And that is, I think, some concern that investors are starting to have. If we look at volatility indicators, it came down substantially during the election. They're starting to rise a bit again. So those are some of the things that we're going to monitor very closely over the next couple of days, next couple of weeks, and make sure that you guys are aware of what we're currently taking a look at. Now, when we look at the US equity markets and we look at how they have responded, there are two sectors at mind that are top of mind for a lot of investors going into the election. That was healthcare and industrials. Healthcare, there were investors that were concerned that healthcare stocks were going to take a hit as Biden with the Democratic sweep was likely going to expand Obamacare. So we saw healthcare, if we look at whether you look at XLV, if you look at specific names, really started to take a hit as the polls started to show that Biden with the Democratic sweep was going to likely be the outcome of the election. But once we got the election results, the early results, where it was likely that the Democrats were not going to be able to have a sweep, that's when healthcare stocks really rallied. And if you look at XLV largely outperformed the market during the initial rally off of the March lows, but then underperformed the broader markets for pretty much 5 months, 6 months or so, and only started to and really started severely underperforming over the past couple of weeks, but then started coming back to life here just based on the election outcome, because there is less of an expectation that there's going to be sweeping reforms on the healthcare side. And this is really one of the sectors that, if you're looking for some bullish opportunities, could potentially start seeing some rotation into healthcare. On the flip side, industrials is the exact opposite. This was one of the industries that were looking at some significant strength going into the election, especially with the Biden and Democratic sweep. There was talks about having a fairly sizable infrastructure bill. And if they had a Democratic sweep, there was the ability to push through a sizable infrastructure bill. And industrials was one of the sectors that were going to be a main beneficiary of that. But since the election outcome, now we expect that this is likely going to see a bit of a cap here and more likely to see some further declines here. And we're going to take a look at some specific names in the sector in our idea section here today. So if we look at the US equity markets, we have seen a fairly established trading range. We expect that trading range to hold for the next at least couple of weeks, in my opinion, potentially a little longer. And then we see some jostling between big cap names versus small cap names, and that slow rotation to value and some jostling within the sectors in terms of rotation here. But when we look outside of the US, when we look internationally, we have seen some significant moves here on the international front. I brought this up on Tuesday. We continue to see this rally here in EEM. So we talked about this because Asia has done a much better job of containing COVID, while the US is looking worse and worse each day that we go on. And we've seen this relative outperformance here from the indices that have more exposure to Asia, specifically EEM that has more exposure to China, to Asia, to technology, overweight technology in Asia. So EEM outperforming US domestic equities. And domestic equities, US equities, have been the strongest by relative strength for a very, very long time. So is this the start of a rotation out of US equities into more foreign equities, especially as the number of COVID cases really start to diverge? This is really one of the places that we're paying attention to. And if we want to specifically look, and I'll show you a chart here later, but Japan also, EWJ, one of the places, if you want to get a little bit more specific within a country, that have seen some outperformance here. So the other thing that we want to talk about here, which I pointed out last night during our election debrief, which is gold. Gold, had a very strong move to the upside. This was one of the plays that we had during our daily play. And then we've had a very long consolidation range since then. We started building into a gold position here about a couple of weeks ago. And now we've seen gold rally again, breaking out from this consolidation range. And you can actually use this as a measure from this 165, 168, all the way up to that 192 as a projection here to the upside, which would project us well above the all-time highs here around 194, closer to that 200 level. So fair amount of upside here in gold. We did start building a position here in gold already. You can take some of those profits and potentially roll them into a further gold position here to the upside. So gold is definitely one of the places that we're paying attention to. When we look at interest rates took a big hit on the election outcome. There were concerns of a fairly sizable stimulus bill due to the election outcome. The size of the stimulus bill, or the expectation of the size of the stimulus bill, was decreased substantially. So we saw 10-year yields collapse from about a little over 90 basis points down to about 71, 72 basis points. But it has slowly reversed back higher. So even though it did take a big hit, it is still within this uptrend of this channel here. So this channel has pretty much held fairly well. As you can see, trading within the top of the range. We were simply at the top of the range, now we're at the bottom of the range. So is this an entry point for a continuation higher? That is what looks like, at least from the charts perspective, still intact. This upward trend is still intact, meaning we still expect stimulus, but perhaps a slightly smaller stimulus bill. But nonetheless, that is something we still expect. So our thesis is still that interest rates will rise here going forward. Now, if we look at TLT, this is a way to play that move on interest rates. As you can see, TLT remains in this downtrend channel, which is the inverse of that 10-year yield. It is still below the 200-day moving average, so our expectations is for TLT to continue on this downtrend. The recent move that we had here, this huge rally we've had on TLT over the past couple of days, this is simply an opportunity, in my opinion, to look and build a short position here for TLT. On the flip side, we've seen this move out of treasuries, but we've seen this inflow into high yield. We've seen this inflow into corporate bonds, investment grade bonds. So high yield actually breaking out from its range of about 85.5 or so, breaking out above that range. So now we can start to see a continuation higher here. And you can see this is a major support or resistance level that has been in place for a long time. And COVID, broke down below this, but it's now starting to break out to the upside. So HYG, fair amount of upside all the way into that 89 level here on HYG. If we look at the VIX, we talked about this giant reversal here in the VIX. So VIX shot up going into the election as there was a lot of anxiety and fear as to what the outcome of the election was going to be. A lot of investors were concerned that we were going to see a Biden with Democratic sweep and markets were going to sell off. That's not what we saw, and the VIX quickly pulled back here. But as we start to go into a contested election, as lawsuits start to get thrown around, investors are starting to get concerned a little bit as again. So VIX starting to pick up again, starting to find that base here around that 26, 27 level, and potentially starting to move higher here again. So volatility starting to move higher. This collapse in volatility did provide an opportunity for those investors that were quick on their feet or quick to pull the trigger to look to buy a little bit of volatility, especially if you think that there's going to be some movements in some specific stocks or specific indices. This is a rare opportunity where if you look at, VIX at 27, 28, historically since COVID is relatively low on the lower end of the spectrum from a volatility perspective. Certainly higher than what we saw back in January and February, but arguably we live in a whole different world. We're in a different volatility regime, and we are on the lower end of that range, if you will. This is what I was referring to before, EWJ, Asia breaking out higher here. As you can see, Japan, Taiwan, China, all of these countries doing substantially better. If you look at some of the Chinese MSCI world indices that have China exposure versus without China exposure, there's a clear divergence that we're starting to see appear over the past week or two. And this really, from my perspective, speaks more to the how they've dealt with COVID more than anything else. And we've seen this move here to the upside. For those of you that like EWJ, this is a trade that Carter brought up on Options Action about a month ago. And we're just starting to see that come to life here, breaking out above that $60 level. I think there's far more upside here on EWJ. And if you look at earnings, one of the things that I actually don't have a chart for this, but one of the things that we've started to see this earnings season is that U.S. equities on beats, when a company beats earnings, has almost zero gain to the upside on average, while the historical average is about stocks would move on an average about 0.5 to 0.7% higher here on a beat on earnings. This quarter, the US is at zero. It's just slightly above zero. Japan is actually moving up about 0.9% on earnings beats. So we're seeing this outperformance here from Asia and specifically out of Japan. So as you look for opportunities in equities, start looking at international markets, especially international markets that have had contained COVID. They are doing much better on a relative basis than the US. On LQD, this is in conjunction to the HYG conversation here. HYG or LQD looking a little different than HYG, but after a strong rally period, similar setup to gold, after a strong rally period, had a long consolidation, and now we've broken here to the upside. So there's quite a bit of room here to the upside if you project that move to the upside. So LQD breaking up to the upside, investment grade. So we've seen the shift of flow away from treasuries into corporates and investment grade and into high yield. This speaks again more towards the market's risk on environment. And if you look at economic indicators, if you look at some of the employment data that we're going to show you here, they all point towards this bullish view here in the broader markets. But again, a contested election in the short run may put a cap to that rally, but long term, that's still our thesis that risk is back on, that we can look for bullish opportunities here in the market. When we look at crude, this is something that we continue to get questions from investors saying, is this the bottom for energy? Can we start buying, or can we still building a position in energy? In my opinion, this is a one-way street. I don't see any evidence of a turnaround here in crude or oil or anything like that. If anything, I think the exact opposite. I think this is a time to continue building short positions here in crude or oil and energy stocks. Every time you get a rally, these are opportunities to short. So this is exactly what I continue to see here from energy and from crude. If you look at employment numbers here today, it came out substantially better than expected. Granted, from my perspective, the numbers don't mean too much here, just because what we have right now with COVID is completely unprecedented. But the fact that we have spiking cases and employment gains are still better than expected, That's part of why the markets have responded fairly positively to those numbers this morning. We were down almost 1% pre-market. After these news came out, we're now up 0.1% here. So a fairly strong reaction from my perspective to the markets have had to this news, despite the fact that COVID cases are still going exponential. We had about 120,000 new cases yesterday, so the 7-day average right now is still going exponential at about 95,000 cases a day. This is going to put, in my opinion, a potential cap on the broader market at rally here in the short run, as well as we go into colder months, as we go into potentially more restrictive lockdowns. Certainly, I don't think we're going to see what we saw back here in March, but in terms of slowdown, we certainly are starting to see that in some of the high frequency data as well. When we look at credit card data, when we look at mobility data, this is all pretty much real-time data. We're starting to see that slowdown. If you look at open table restaurant bookings, those have started to turn down already. Those have been trending up for quite a few months, and we started to see a reversal lower. If you look at travel data, TSA data starting to slow down as well. Leisure travel slowing down, corporate travel not moving at all. This is concerning for investors. If you look at energy demand, this is also some of the things that I'm referring to as far as consumers asking or investors asking whether it's time to start building a position in oil. Gasoline demand still at multi-year lows. Refinery inputs well below multi-year lows. So not seeing this uptick, not seeing this reversal that we're talking about here in energy. It looked like it was starting looking like it was starting to get back to normal again, but it's fading very quickly here. So that's why we're not particularly strong here on the energy sector. Now, again, when we look at that high frequency data, when we look at credit card data, when we look at travel data, American Express is one of the few major financial institutions that's extremely sensitive to both consumer spending as well as travel. And this is really one of the stocks that recently broke down below some major support levels here. It had a pretty significant rally here over the past couple of days, but I actually think that this rally is an opportunity to look for potentially a short position here. As you can see, momentum looking fairly weak here. Money flow looking fairly weak here over the past couple of days, and also quite a few weeks now. And this rally, in my opinion, is an opportunity to look for or build a short position here in a name like American Express. On the flip side, when we see this exponential rising number of cases in the US, and it's not being contained very well, and we're starting to see hospitalizations go up. We're seeing hospitalization strain in the South. This is really one of the COVID stocks, if you will, the lockdown stocks that did very well during COVID, really faded a bit for quite some time, but is basing here and has the potential, in my opinion, of going higher here. Now, I don't see this as a strong move to the upside per se. I think this is one of the positions that's going to be much slower moving. So my preference is to sell put spreads. As long as Clorox continues to move sideways, you're going to be able to profit. If it starts to rise, you're going to be able to make profits a little faster than expected. But my expectation is that you move sideways and start grinding your way higher here for a name like Clorox, as again, COVID cases continue to spike. On the flip side, on the flip side of that energy trade, we talked about looking at short energy. Now, if you're not comfortable shorting energy, it's a volatile space. It's not particularly cheap to short energy. On the flip side, what you can do is take a bit of a contrarian view of taking a look at renewables. And there's plenty of stocks that you can do this. You can do solar, you can do electric vehicles, you can do renewable energy or utilities. So Sunrun is one of the, I would say, interesting names in this particular space that really came to life here back in July and August. So you've had this very strong run to the upside. I felt that this was going a little too far too fast, and it's now had almost a 30-40% decline here, and on earnings started to pop up higher here. So fundamentals, in my opinion, support this long-term bullish view here. So I particularly like this current setup where you've had this long consolidation, or sharp consolidation, I should say, and we've now had a breakout here to the upside. Similar setup to what we've seen in terms of a pattern to gold, to LQD, but looking at, again, a thesis that from my perspective, is a strong thesis going out, not just this particular quarter, but going out of next few years, looking at renewables, looking at clean energy, away from fossil fuels. This is the type of investment thesis that I truly believe in the long run. And this is one of the names that I certainly am paying attention to in this particular space. I also brought this up during our election special. For those of you that are members that were able to attend our members only special, this was one of our top names on the renewables front with respect to a potential Biden victory with the Democratic sweep. And even without the Democratic sweep, the numbers that came out here from earnings yesterday on Sunrun, extremely strong, extremely positive. So that's why the stock jumped. And I think there's a continuation for the stock to move substantially higher. When we look at industrial names, so I talked about this earlier, we talked about industrials suffering as a result of the current election outcome. When we look at a name like Caterpillar, which was one of my picks here on CNBC a couple of months ago, we've had that big run up here in Caterpillar. And right now, this rally is really fading, in my opinion, after the election outcome. So this is really where I see some risk here to the downside, or at least I feel that this is a stock that probably has found at least a top or a top end of the range here for now. So this is the type of stock where I would look to sell some call credit spreads. So we talked about selling some put credit spreads on a name like Clorox because we think that that's basing and starting to trend higher. This is the exact opposite for a name like Caterpillar, where we think, at least for now, maybe has found some short-term resistance here to the upside in a name like Caterpillar. And then again, on the flip side of this, when we look at healthcare space, so we talked about industrials finding a little bit of weakness here, healthcare finding a little bit of strength. This is a name that Michael Coe brought up, I think on the same week that we talked about EWJ, the Japan ETF, where we were quite bullish here on United Health Group. And this is one that popped up significantly due to the election. And this is one that, was on a pretty strong trajectory to the upside and has now actually broken out to the upside. This is an extremely bullish pattern here from a technical perspective. So when you look at healthcare space, these are the types of names that we want to pay attention to. These are the names that are going to be a beneficiary with Biden with a split government, where there were concerns about huge expansions to Obamacare and what that meant for the healthcare space. That is looking less likely, especially with the split government. Even though that's still not decided yet, and there could be to a point where the Democrats have 50 seats in the Senate with the vice president being the tiebreaker here. So they could potentially still maintain majority, if you will, with the vice president as the tiebreaker here, but looking less likely. And that's why some of these healthcare stocks are rallying. So with that covers what I wanted to share with you here today. Like I said, a lot of things can happen here over the next couple of weeks, but there are some clear trends that are emerging. Foreign stocks, especially Asia stocks, are pay attention there. If you look at fixed income, huge outflow out of treasuries into high yield and investment grade. And we are starting to see some sector rotation within healthcare, within industrials, looking at renewables, away from fossil fuels. These are the theses that are starting to build as a result of this election outcome. And those are the ones that you want to pay attention to long term. There's going to likely be a little bit of noise here over the next couple of weeks. So we will make sure that we help you navigate that and stay on top of that. So with that covers what I wanted to share with you here today. I'll try to answer a couple of questions here before we wrap up here today. If you have a question, please type them into the chat window or the Q&A window here. How do I get these charts? You can look at so I use TradingView as my charts. Good morning. What do you think about BABA after the failed Ant Group? So this is something I answered yesterday. I think Ant Group will refile for an IPO, certainly perhaps not at the same valuations that they were hoping for. They were hoping for tech valuations, even though for all intents and purposes it was a financial institution. And that's what the regulators came in and stopped. Whether you agree with that or not, I think is sort of irrelevant, because at the end of the day, China is going to flex their muscles whenever they want to or need to, and that's what they've done. So Ant Group will likely refile, but probably trade closer to more of a financial institution multiple rather than a tech company multiple. So that is going to take a short-term hit on BABA, but I don't think it's going to be that big of a hit in my opinion. Mr. Zhang, behind you does not look like the Peloton bike. That's true. That's my road bike, and the Peloton bike is in the other room. Then Peloton, great results the other day, or rather last night. Came down a little bit, but opening only about 2% higher here. Peloton, long run, still a stock that I like, especially with COVID cases continuing to rise. Okay, I think that's unfortunately all the time that I have for here today. I hope this was helpful in giving you a better understanding as to how to navigate the current markets. And I do want to thank our members for supporting us and allowing us to continue doing this. So if you are not on a free trial, if you don't have access to OptionsPlay, sign up for a free trial at optionsplay.com. And if you don't currently have a subscription, please consider supporting us by becoming a member at optionsplay.com or trade.optionsplay.com/member. Membership is just $75 a month or $500 a year. Thank you so much. Have a great day. And I will send you the recording after we finish here in about half an hour or so. And I'll see you guys on CNBC later this afternoon. Have a great trading day.